first, and then I look for this particular button which is written like a bullet, like this. So on this button, on top of it, I'll be able to see extrude. So extrude, we have, ladies and gentlemen, to say here, extrude. We must say, ladies and gentlemen, extrude. We must say shift, because the extrude is written in form of, is written in yellow color. Yellow means what? Yeah, shift. So shift this button, and then we shall see extrude. So 2.25. And then I say equals. Once I say equals, I'll press -1. I will press -1. So could you kindly do that, and then we compare notes and see whether we shall be able to get what Madam Eunice got there, 31.04. 31.03 from Subo. That is still correct. We have Judy, the same. Sumaya now is getting 31.03. That is how we get the growth rate. That's how we get the growth rate. Now, ladies and gentlemen, I have a lengthy question with us here today. I would want us to finish this topic today. We finish it today once and for all. This question was tested in section 5. It's quite a comprehensive question that they borrowed from section 3 and took it right away to section 5. And that is why it is important for all of us to understand financial management in section 3. Because if you don't understand financial management in section 3, for sure, you will have very big challenges when you will be in section 5 CPA. When you'll be in section 5 CPA. We don't want that to happen. We must master this thing here. We must master it here. So somebody, I would want us to straight away go to our past paper. We go to, not our past paper, but to the screen there. On your screen there, ladies and gentlemen, you'll be able to see our great question there, which is an AFM question. AFM question. Just trying to locate the sitting. Great. I've been able to see it. For the students who are following Mwalimu here live on Facebook and who happen to be having this RCM's revision kits for section 5, you will simply need to go to page number 112. 112. It's a CPA section 5 question, which was tested on May 2016, question number 3. May 2016, question number 3. So I have already put the question on the screen there, and I would want you to take like a minute to go through that particular question as fast as you can, and then we'll be able to continue. Am I going through? Let's continue. Let's continue. You're back here. We are told on 1st January 2016, Mavuno Limited was in the process of raising funds to undertake four investment projects. These projects required a total of 30 million Kenya shillings. Given below, we are told here, given below are the details relating to the 4 investment projects. The company has 9 million available from retained earnings as at 1st January 2016. Okay. So remember the question, the ones who are asking on Facebook, the question is May 2016, question 3. May 2016, question 3, AFM, of which you are told on 1st January 2016, Mavuno Limited was in the process of raising funds to undertake 4 investment projects. These projects required a total of 30 million. Given below are the details relating to the 4 investment projects. So we have project A to D. We have required initial investment, and then they have given us internal rate of return. Additional information, the company has 9 million available from retained earnings as at 1st January 2016. Any extra equity finance would have to be sourced through an issue of new ordinary shares. Note 2, the market price per ordinary share on 1st January 2016 was 25.6x dividend, which is very good for us. Whenever you have these items being given to us, ex-div, that makes our work very easy. Information relating to EPS and DPS over the last 6 years are given there. Note number 3, issue of new ordinary shares would attract a flotation cost of 4.6 per share. Note 4, 9% irredeemable debentures whose par value is 1,000 could be sold with net proceeds of 95% due to a discount on issue of 2% and a flotation cost of shillings 30 per debenture. The maximum amount available from the issue of the 9% irredeemable debenture would be 4 million, after which debt could only be obtained at 12% interest with net proceeds of 90% of par value. Note 5, 10% preference shares can be issued at a par value of shillings 80. Note 6, the company's capital structure, which is considered optimal, is as follows. So whenever you see an optimal capital structure being given to us in form of percentage like that, in short, what they're giving us is the weight of equity. If I were you, I would have written in brackets there, WE. Weight of equity is 45%. So 45% is the same as 0.45. We have preference share capital, 0.3. So weight of preference is 0.3. And then weight of debt is 0.25. They're telling us, ladies and gentlemen, there are 7. The corporate tax rate, which is applicable, is 30%. 8. The company has to exhaust internally generated funds before raising extra funds from external sources. So they want us to give them in part A. If you go to part A, they want us to give them the levels of total new financing at which breaks occur, So in short, they want us to ascertain the break points. They want us to get the break points. There are very, very many formulas of getting the break points, but of course, having gone through a lot of literature myself, I know the easiest formula of getting a break point. How do we get break point? To get a break point, ladies and gentlemen, the easiest way is for you to know that we shall be computing break points for each item of the capital structure one at a time. And as such, we'll begin with the break point of equity. So right there, break point of equity. So break point of equity. And by the way, are you able to see my board very well? Are you able to see my board very well? Somebody, please, I would want some response. I would want some response. Are you able to see my board very well? Yes, thank you very much, Eunice. Someone else to confirm. Thank you very much. We are okay. Thank you very much. Now we can continue. So they want us to give them the break point. So how do we get this break point? So break point of equity. Break point of equity, ladies and gentlemen, will take the maximum equity amount equity amount available. You divide this by the weight of equity. We divide this by the weight of equity. We divide this by the weight of equity. So to get break point, BP stands for break point, we shall take the maximum equity amount divided by the weight of equity. When you remember these concepts very well, equity has got two components. Equity has got two components. Ladies and gentlemen, equity has got two components. We have the retained earnings and what here ordinary share capital. Retained earnings and ordinary share capital. And that is why the first break point, ladies and gentlemen, break point number one is break point for the first retained, or rather for the first equity component, which is retained earnings. And for retained earnings, in this case here, we'll work with the maximum retained earnings amount available. The maximum retained earnings amount available, these people have told us, if you could just scroll that question for them. This examiner has told us, in additional information note one, additional information note one, you'll be able to see that the company has 9 million available from retained earnings. So 9 million is the maximum that we have. 9 million is the maximum that we have out of what your retained earnings. So then the maximum retained earnings here will be equal to, we have here 9 million all over the weight of equity that you are able to write down on note number 6. The weight of equity capital is 45%. 45%, ladies and gentlemen, is 0.what here? Is 0.45. Is 0.45. There is a student who is asking a good question here. What does break point mean? What does break point mean? And I would want to throw this question to you. You guys are great scholars. I would want to go to your phones. I would want you guys to go to your textbooks and try searching for this particular word, break point. Try searching for break point, and then you give me the best definition. Give me the best definition of break point. So you can even Google. I would want this definition here to come from my great students. The definition is going to come from my great students. What is break point? Somebody. This definition will come from you. Break point. The point at which we expect the cost of capital of a company to change. So if somebody tells you like, if you want all the way up 20 million, I can only give you any amount here up to 20 million at what interest rate? Perhaps 10%. But if you want more than 20 million, then the rate breaks and it becomes a little bit expensive because now we'll perceive you to be a risky client. Of course, the risk, we expect the higher the risk, the higher the return to the bank. So at the break point, what is happening? Somebody, Catherine asked a very important question, and I would want that definition to come from you. As I wait for this great definition from my great students, I would want to explain and tell you that break point basically gives us that particular range within which the interest rate will be the same. Outside that range, we'll have the rate of interest increasing in a lump sum way, At times they call it the point of total financing, 100% financing, assuming in this case here that the 9 million that we have here, is equivalent to 45%. How about an amount which will be equivalent to 100%? 100%. I'm here to get somebody giving us great definitions here. I'm here to get students giving me great definitions here. Yes, I can see from Cynthia. Cynthia says, breakpoint is a point where a given source of finance is exhausted. A given source of finance is exhausted, so that the investor uses the next source of finance, which will be expensive. I like that definition, but I know someone else will be able to come up with something a little bit different to suit exactly what I was trying to define for you. I'm so sure that somebody this evening will give me some other Remember, it's a learning process. You're trying to learn. So is there anybody who has been able, remember the way you do your search? The moment you get an answer, you copy, you paste it here. You paste it. You'll do something nice like what Cynthia has done. Something nice like what Cynthia has done. Breakpoint. The point at which the cost of capital over a company changes. The point of finance at which the cost of capital over a company changes. So of course we have to exhaust the cheaper source. And then when we go to the next source, so we expect now the next source to be a little bit expensive. And that is why the MCC curve keeps on rising like staircases, rising like staircases. I can't see anyone else coming in to give us a different definition, but I believe from the explanation that I've done, together with what Madam Cynthia has been able to give us here, and to believe now Catherine has got an idea. Catherine must be having an idea. So is that okay, ladies and gentlemen? Is that okay, ladies and gentlemen? Thank you very much. So now we are getting breakpoint of retained earnings here. So in this case here, could you kindly give me 9,000 divided by 0.45 will give me what, somebody here? 9,000. I am waiting. Thank you very much. Phoebe tells me it is 20 million. Thank you very much. Very many students have been able to really rise up to the occasion, and they've been able to give me the first break point. They have been able to give me the first what year? The first break point. Now, ladies and gentlemen, let's go straight away to the second break point under equity. The second break point under equity is what we call the break point of what year? Ordinary shares. Remember equity capital. Equity, please don't forget this, that equity has got how many components? We have the retained earnings, and then we have got OSC, ordinary what year? Share capital. Now we are looking for the second break point, which is basically a break point under equity of ordinary share capital. So the same concept, I will look for the maximum amount which will be raised from this ordinary share capital divided by the weight of equity. So please take me back to the question. So this question, ladies and gentlemen, you can see additional information 1 tells me the company has 9 million available from retained earnings as at 1st January 2016. Any extra equity finance would have to be sourced through an issue of new ordinary shares. Brilliant. Note 2, the market price per ordinary share on 1st January 2016 was 25.6x dividend. Information on EPS and dividends per share over the last 6 years is as follows. So you can see they have given me many years DPSs. Dividends per share, you can see like 2010, 2. Ukiona umekupatia DPS mingi, hizo DPS sio maua. Ukiona DPS inakuja mingi, this examiner would want you to compute the growth rate. The examiner would want you to compute what year? The growth rate. The examiner would want you to compute the growth rate. And that's not what I want to compute at this particular point in time. Look at note 3. Issue of new ordinary shares would attract a flotation cost of shillings 4.6 per share. And then on note 4, ladies and gentlemen, talks about debt. So meaning that these people have spoken about ordinary shares many times. But honestly speaking, in those notes there is nowhere where they have specified the maximum amount that I'll be able to derive from this particular source called ordinary share capital. They haven't specified any amount. There is no maximum limit given that we can get from ordinary share capital. So basically, this breakpoint for ordinary share capital, we are saying here that there is no limit, there is no limit, there is no limit, and therefore, there is no breakpoint. There is no limit, and therefore, there is no break point. And therefore, there is no break point. There is no limit, and therefore, there is no what here? There is no break point. Remember, for us to be able to compute a break point, there must be a specification. There must be an amount on that particular, in that particular source that has been specified. Like for retained earnings, indeed, they did specify for us the 9 million Kenya shillings, which was available under retained earnings. But ordinary shares, they've given us flowery language, very great language. But at the end of the day, they haven't specified any amount for us under ordinary share capital. Now, ladies and gentlemen, from there we go to note number 4. So note number 4, that now opens for us a door to computing breakpoint of debt. So mention there breakpoint of debt, breakpoint of debt. So breakpoint of debt, what do we have here? Breakpoint of debt, what do we have, ladies and gentlemen? So under debt, ladies and gentlemen, I have here breakpoint of debt. So I'll come and write the formula first. That breakpoint of debt will be equal to, maximum amount. Breakpoint is all about the ceiling. That point, in this case, that point at which we shall tip over, the tipping point. So we must be having the maximum amount. So under breakpoint of debt, I will come and talk about the maximum amount of debt all over weight of debt, all over weight of what here? Debt. So maximum amount all over weight of debt, all over weight of what here? Weight of debt. Maximum amount all over weight of debt. So then my work becomes very simple. My work, ladies and gentlemen, will be to look for these maximum debt amounts and then you plug them in the equation. So we are reading together note number, let's read together note number 4. Let's read together note number 4. Note number 4. So for the students who are following this Mwalimu on Facebook, I'm making a request that you just get to share this particular post. You share it on your timelines. Share it on your timelines. If you do that, I'll be a happy man. I'll be a happy man. I'll be able to buy you something very nice. I'll buy you something very nice. So straight away, ladies and gentlemen, we are told there on note number 4, note number 4. Note number 4 reads, 9% irredeemable debentures whose par value is 1,000 could be sold with net proceeds of 95% due to a discount on issue of 2% and a flotation of shillings 30 per debenture. The maximum amount available from the issue of the 9% irredeemable debenture would be 4 million. If you guys had this paper with yourselves there, I would have told you to underscore. I would have told you to underline this line, which is talking about irredeemable debenture would be 4 million. The maximum amount available from the issue of the 9% irredeemable debenture would be 4 million shillings. Would be 4 million shillings. So, ladies and gentlemen, here we are. So we are talking of breakpoint 1. So breakpoint 1 will be equal to the maximum amount. Maximum amount, what do we have? The first breakpoint. The maximum amount that I'll be able to get out of this is 4 million. 4 million. Divide this by the weight of debt. If you could take me to the question, divide by the weight of debt, and the weight of debt will be able to see. You can point to them. This 25. That 25 there, yes, 25%. So you divide this by 0. What here? 25. You divide by 0.25. 0.25. So could you kindly take 4 million divided by 0.25, give us an answer. 4 million divided by 0.25, give us an answer. What do we have here at the end of the day? 16 million? 16 million. Thank you, and thank you very much. Now, ladies and gentlemen, I can see here I've got more than one debt instrument. I have this 9%, and I can see I've got another debt instrument of 12%. So I would want somebody to take a step of faith and give me the second break point of debt. The second break point of debt. This was from this instrument whose coupon rate is 9%. How about from this other instrument, which is 12, carrying an interest rate of 12%? Yes, so 12%. What do we have there, somebody? 12%. What do we have there, somebody? %. What do we have there? Somebody talk to us. So I'm waiting really to hear what my students have there. Now, ladies and gentlemen, for this 12%, really, I will not even bother at all. I will not be disturbed at all, because what they have told us is that irredeemable debenture would be at 4 million, after which debt could only be obtained at 12% interest rate with net proceeds of 90%. So meaning that this examiner has not defined the maximum amount realizable out of this particular vehicle. For those of you who love, ladies and gentlemen, for those of you who love watching movies, there used to be this great movie which used to go by the name, There Is No Surrender, something like that, No Surrender, whatever, where we were being told, no retreat, no surrender, yes. So in this particular case, we don't have, so there is no limit. There is no limit. There is no maximum amount that has been specified here. So there is no limit, and therefore, there is no what here, somebody. You just write like that, and you are at home. You just write like that, and you are at home. So, and that is it. That is it, ladies and gentlemen. Now go to the next vehicle. The next vehicle under equity, or rather under company financing, is what we call the preference share capital. So come and give us the breakpoints of preference share capital. Give us the breakpoints of preference share capital. Breakpoints of ordinary, not ordinary, but preference share capital. Preference share capital. The first mark that I'll get if I'm calculating these breakpoints is the mark, ladies and gentlemen, of you writing down the formula. So first of all, write down the formula for us. So the formula for this will be breakpoint of preference. This will be equal to maximum amount of preference share capital. Maximum amount of preference share capital. Maximum amount of preference share capital divided by the weight of preference, divided by the weight of preference. Teresia says she can't see Mwalimu and to believe it is a problem from our side, internet. So the very best thing you need to do, Teresia, is to, of course, get out of the meeting and then you join again. You get out, join again if you can hear me. So I would want to take a minute of silence and wait for you great students of mine to compute for me the first breakpoint of preference. Just 1 minute, I'll remain silent, and then you compute for me the first breakpoint of preference. You will be the first among the first students to get this right. We need to give you a present, right? We need to give you a present. We need to give you a present. We need to give you a present. So I'm waiting. The question is there with us. Sorry, we forgot to put it there. So is there somebody who has already gotten that breakpoint of preference? Breakpoint of preference. I'm waiting. The breakpoint of preference, ladies and gentlemen. If you read the one of preference share capital very well, ladies and gentlemen, that is not number 5. They have just told us that 10% preference share capital can be issued at a par of shillings 80. But they have not told us, ladies and gentlemen, out of these preference shares we'll be issuing, whose par value is 80, how much do we expect to raise out of this? How much? They haven't told us that. So meaning that under preference shares, we don't have any breakpoint. So there is no limit here, and therefore, no what here, no breakpoint. And indeed, somebody had already obtained this, had already gotten this correctly. I happen to be having, by the way, very bright students who are following Mwalimu here on Zoom, the best of the best. So are we answered number 1? Number 1, they wanted us to give them the levels of total new financing at which breaks occur in the weighted marginal cost of capital, MCC curve. Later on, we'll be able to see what this MCC curve is. The most important take-home thing that I would want you to appreciate is how to calculate the breakpoint, which will become even clearer when I go to the second question. For now, I know there could be a few issues here and there, but you need also to raise them up with me. Just type there. That is a good thing with Zoom. Even Facebook, you simply type there. Now go to part B. Part B, they want us to give them the weighted marginal cost of capital. Ladies and gentlemen, there is no way I will be able to get this cost of capital without getting the component costs. So the first thing that I need to do is to go ahead and get cost of equity. So I would want to see whether there is any student here who will be able to help Mwalimu ascertain the cost of equity. Could you kindly help me ascertain the cost of equity? How do you get to help me? And you happen to have forgotten the formula of getting the cost of equity. Kenya, KE. So cost of equity, ladies and gentlemen, cost of equity here equals, we have our district officer who has to grow all over our provincial officer. If there is any flotation cost, I'll be saying minus what? Minus flotation. Plus what, ladies and gentlemen, here? Plus G like that. So please write down this formula. Cost of equity equals, we have DO into 1 plus G all over PO minus what here? Flotation, minus flotation. And then at the end of it all, we have the growth rate. At the end of it all, we have the growth rate being added. Now, ladies and gentlemen, here we have 2 types of cost of equity. We have cost of equity for retained earnings, and then we have cost of equity for ordinary shares. So I would want us to take this opportunity to get the cost of equity of retained earnings. However, ladies and gentlemen, even before that, I can foresee a problem. Look at note number 2. Look at note number 2. Note number 2 there on your screen. They have told us the market price per ordinary share on 1st January 2016 was 25.6x dividend. Information on earnings per share and dividends per share over the last 6 years is as follows. So they have given me many, leave alone the EPSs. This G is growth rate of dividends. So I need to come here and calculate the growth rate. I need to come here and calculate the growth rate of dividends. The growth rate of dividends. So growth rate of dividends, which is our G, will be equal to, remember the formula, it's n minus 1 root. We have the most current what year? Dividends per share, all over the oldest DPS, and then whatever I will get at the end of the day, I must come and deduct 1 there. I must come and deduct 1. So ladies and gentlemen, then come and give us this G. So G, I need first of all to get the number of years. Number of years, please count them from 2010. How many years do we have there? If you look at the question, how many years do we have there? 2010, 2011, 2012, 2013, 2014, 2015. 1, 2, 3, 4, 5, 6. So those are 6 years. So you talk of 6 minus 1, meaning that they would want us to give them the 5th root. They would want us to give them the 5th root because of 6 minus 1, the 5th root of the most recent or current dividend per share that I'm able to see in this question. If you could just pin for them, that I'm able to see from this question is 3.5 all over the oldest DPS. The oldest DPS, 2010 DPS, the oldest here is 2.5. 2.5 minus 1 like that. So now here you have to be a bright student. Go there and punch 3.5 divided by 2.5. You punch 3.5 divided by 2.5. Whatever you get, please look for the 5th root. Look for the xth root. Xth root. In many calculators, the xth root will be this particular function which is on top of this arrow, So the xth root. So you press 5 first and then shift, because this is in yellow. So 5 first, shift, and then you press now this. You'll be able to see there this thing coming like this. 5th xth root of whatever number that you got there. And then you say equals first. Once you say equals, whatever you'll get there, you subtract 1. And once you subtract 1, ladies and gentlemen, multiply by 100. Multiply by 100, and then you'll be able to advise us what percentage are we getting. I can see from Collins Muteti. I can see from Sumaya. I can see Judy. I can see Catherine. I can see Eunice. The very best is to come and work with 6.96%. So we have here 6.96%. 6.96%. So we have our G is 6.96%. 6.96%, like that. So now, having gotten G, now what we need to do is just to plug in figures to be able to get the cost of equity of retained earnings, which I'll be abbreviating like this. Cost of equity of retained earnings, which I'll be abbreviating like that. So remember DO, if you are writing, DO is supposed to be the most recent, the current dividend. The current dividend. If my friend here could just pin that question for us on the screen, ladies and gentlemen, you'll be able to see where we have many years, 2010 all the way to 2015. 2015 is our most current year, it's our current year. And therefore, the current dividend per share is supposed to be 3.5. It's supposed to be 3.5. 3.5 into 1 plus the growth rate that you guys gave me, which is 0.0696. All over PO, remember if you're writing, PO stands for current market price per share, PO. PO stands for the current market price per share. So the current market price per share in note number 2, they have told us the market price per ordinary share on 1st January 2016 was 25.6. That is note number 2. The market price per ordinary share on 1st January, most current, is 25.6. 25.6. And if you remember very well, ladies and gentlemen, for retained earnings, we do not charge any flotation cost into our expenses, because retained earnings really is money that we already have. This is money that is with us live. It's money that we already have. So minus 0 plus the growth rate, which happens to be what again, which is 0.0696, like that. So could you kindly now get your calculators out? First of all, endeavor to get what we have in the numerator. So you say 3.5 times 1.0696. And then you divide this by 25.6. Whatever you get after you've done all that, please go ahead and add 0.0696, and then you give me an answer. You give me an answer. Tell me, what are we able to get there? What are we able to get there? Yeah, from Abby tells me 0.2158. So this is 0.2158, which is the same as 21.58 what year percent. Is there any, they got these, many of them. I can see Galaxy, I can see Cynthia, I can see Martin Mwangi, I can see Anne. Thank you and thank you very much. Thank you and thank you very much. Now, ladies and gentlemen, we go to the next thing. Remember, this is cost of equity, retained earnings. Now I have to look for cost of equity, ordinary share capital. Cost of equity, ordinary share capital. If you allow me. Okay, ladies and gentlemen, cost of equity, ordinary share capital. Cost of equity, ordinary share capital. Cost of equity, ordinary share capital. So the same formula. Remember, equity holders, normally they get what in form of a return. They normally pay dividends. So come and give us here what we call DO into 1 plus G. Divide this by what they gave us, which is what here PO. Divide by PO. Ladies and gentlemen, remember, especially for ordinary share capital, there is no way you should ever forget what here, the flotation cost. There is no way you should ever forget the flotation cost. The flotation cost. That has to be remembered. That must be remembered. That must be remembered. Now, for us to be able to answer this very well, look at Roman 2, or rather, additional information 2. Additional information 2. What are they telling us there? That the market price per ordinary share on 1st January 2016 was shillings 25.6 ex-dividend. So I already have there the PO, the current market price per share. I already have that. Information on earnings per share and dividends per share, that we've been able to use that information to get the growth rate. Look at note 3. Issue of new ordinary shares would attract a flotation cost of 4.6 per watt year per share. And that is it. So now with that information, I should, ladies and gentlemen, be able to give them the cost of equity of ordinary shares. where I can see the most current dividend, which is our DO, the most recent dividend, which is our DO 2015. If you can see in this particular table, 2015, if you could just show them, 2015, you can see 3.5. You can see 3.5. You can see 3.5. I hope you're able to see these figures, ladies and gentlemen. Like this 3.5 is here. 2015, this 3.5 is here. 3.5. The most current dividend is 3.5. So we have here 3.5 into 1 plus the growth rate that you gave me all over the current market price per share that I've been able to read here as 25.6 minus our flotation cost. Flotation cost, ladies and gentlemen, flotation cost, they have told us that each share attracts 4.6. And then lastly, ladies and gentlemen, I can see, of course, they need me to come and add the growth rate, which is 0.06 what here? 96, 0.0696. So then can you kindly come and give us this parameter? And I can see from Phoebe and from Catherine that the correct answer is supposed to be 24.79 what here percent. Is there somebody who is able to get for us that 24.79%? Yeah, I can see 2 students give. Great. Even Eunice Njeri has also been able to get this 24.79. 24.79. Now, during our commercial break, it's important to take some break. Very important to take some break. Remember, I will be teaching what we call advanced Excel. Advanced Excel from tomorrow. From tomorrow, we shall be having what we call advanced Excel. Now, I would want to know from you, great students of mine, is there anyone in this classroom, in this meeting today, who happens to be very good at advanced Excel? Is there anybody in this class who happens to be very good in advanced Excel? Yes or no? For you to say that you are very good in advanced Excel, leave alone those things of functional sum. No. We are talking of how do you extract data from, in this case here, ladies and gentlemen, a mammoth database using the shortcuts. How do you pivot? If you remember the concept of pivot tables, right? How do you search for values using the lookups? That is VLOOKUP, HLOOKUP. How do you move between rows, ladies and gentlemen, using, for example, the index? You know, somebody who knows, ladies and gentlemen, advanced Excel so serious like myself. Advanced Excel is something that can give you good food. Is something that can open great doors for you. Great doors for you. I told you the other day, like most of the consultants that I'm doing currently, I normally get them courtesy of who? Advanced Excel. That I can go and capture like the entire of IGAD, the entire of African Union. I capture their data on Excel. Don't joke with the Excel that you have there. That Excel is a serious paper. Serious thing. So ladies and gentlemen, what you would need is simply to come and attend my class, and you're charging 3,500 Kenya shillings, 3,500 Kenya shillings. And of course, if you're interested for you to be able to get to know exactly what happens here, for you to be able to get this skill that many people don't tell you. As an accountant, there is no way you'll become an accountant if you don't know this. Because at the end of the day, most of us will be involved in what we call mergers and acquisitions. When 2 companies want to come together, they want to consult you as an accountant. So how do you go into a mergers and acquisitions meeting in the first place if you don't know Excel? And yet Excel is the model that is used for corporate valuation. So once you have the cash flows, you know, be having so many cash flows that if I buy, for example, this company, if I buy Summit today, if I buy RCM today, how much do I expect in terms of cash flows over so many years? Say 100 years. You see, if you're doing it manually, like the way we do it here, you can't. You'll be so tired. That is why for your exam purpose, we only give you like 4 or 5 years. But practically, farms are normally assumed to be with us in the long term, So you have to work with like cash flows for 200 years, right? You assume revenues, you assume costs. So we have, in this case here, parameters, assumptions you put down there. And then now those assumptions are the ones you keep on changing. What if this changes? What will happen to my profitability? What if after some time again we are hit with another corona? How will that curve look like? And now, given whatever profits we have here, remember the concept of adding back depreciation. You get cash flow. Have an assumption there where you have the cost of capital. So with this cost of capital, that Excel will be able to pull all those cash flows from those many, even if it's 1,000 years, you'll be able to pull all of them to today and tell you, hey, this organization's net present value is 20 million. Hey, don't pay more than the 20 million shillings for the company. And of course, because we know that because of assumptions which may keep on changing, the farm may not be worth exactly that amount. That is why advanced Excel allows us, ladies and gentlemen, to always change the assumptions through what we call sensitivity and building up of scenario models. So that at the end of the day, you give like a range that I can only accept to merge with you. If you guys, in this case, you accept this amount between 20 to say 30 million like that. So you end up giving what here? A range. Is there anybody who has a question? I've digressed a little bit, but I felt that this is something that is very important. If I happen to forget it, many companies charge all the way up to 80 or even 100,000 for this advanced Excel, and yet they can't reach the level of Excel that I have. Actually, it is a CSR for me. It's a CSR for me. And the earlier you get to understand these things, the better for you. The better for you. Why? Because remember, Excel needs a lot of practice. It means that by the time you finish this thing, you ought to be so good in Excel. So the course is starting tomorrow. This is the amount to be paid, ladies and gentlemen. And of course, you pay it through our pay bill number, which is 402-956-9. 402-956-9. This is our pay bill. The account, you simply put your name and your course. We have many courses, name and your course, the name and your course. And then of course, the moment you do that, for you to be able to, this was an offer, which by the way is ending today by midnight. But because I am late to give you the information, I can also squeeze this a little bit and extend the offer for you up to tomorrow. Tomorrow by 12 p.m. System channel. So if you're able to pay this, and then you share the message with me, I'll be able to add you onto our WhatsApp group, which is quite active, where you're going to basically be discussing whatever concepts that we have, whatever concepts that we'll have understood. It's important. We'll be discussing them like that. So is there anybody who would be willing to join Mwalimu here? Is there anybody who would be willing to join Mwalimu here in these advanced Excel classes? Is there anyone who would be willing to join Mwalimu for these advanced Excel classes? Yeah, Phoebe. Thank you very much, Phoebe. Who else? I want like 5 students. You have to support your Mwalimu. So at least I've gotten one. I'm waiting for someone, like 2 or 3 students. I know these are tough times, but we have to sacrifice for knowledge. Abby the same. Abby, yes. How about gentlemen? The boy child. Where is the boy child? The boy child can't be left behind. These are very important concept. Very, very important concept. I'm waiting for 2 more. 2 more who will be able to come and learn so that they'll be able to tell the other students, so that in the next month, when I'll be charging them 50,000, they will be willing to pay 50,000. It's a 1 month course, which is very important. So Phoebe and Abby, thank you very much. The moment you make payments, please don't forget to liaise with me. So that I can share with you the timetable. And I would also want to extend the same to the other students. Please ensure that you walk through this journey of your CPA under my mentorship. You cannot go wrong. I've been able to connect so many students with serious jobs. Yeah, simply because there are things that once you know, and you get a big company like Colonel Corbin calling, you want a very good finance analyst, you give them somebody who is good in Excel, who is good in Excel, who is good in Excel. Thank you very much, Zamzam. Those are three. That's good. Thank you very much. I hope you have taken the details. I hope you have taken the details, the pay bill number, etc., etc. Now we are doing costing. We are doing costing of our capital structure components. I've been able to get cost of equity. Now I want to get cost of preference shares. So mention there, cost of preference shares. Remember, we have to do cost of equity, cost of preference shares, and then we have cost of debt, cost of debt. So we start with cost of, we have finished cost of equity. Now we are at cost of preference. So for cost of preference, remember what the preference shareholders normally get. Preference shareholders, ladies and gentlemen, normally get what we call the preference dividend. The preference dividend. So we have here cost of preference shares. This will be equal to cost, or rather the preference dividends, all over the market value of preference dividends. Please write that in full. All over market value, the current market value of preference share capital, of preference shares. The current market value of preference shares. If there is any flotation, you have to subtract flotation. But again, remember, ladies and gentlemen, that for preference shares, we normally have what we call a fixed rate of return. The preference dividends don't grow. So there is no way you can come and tell us here into 1 plus G. No, no. So ladies and gentlemen, come here and give us the preference dividend. The preference dividend, please look for the dividend percentage. In note number 5, if we could pin this, in note number 5, 10% preference shares can be issued, So 10% of par value. 10% of par value. So then this will be 10%, which is 0.1. Please look for the par value in the question. In the question that is pinned there, our par value, ladies and gentlemen, our par value in the question which is pinned there, our par value is 80. So 0.1 times 80, which gives me 8 shillings like that. 8 shillings like that. Now, ladies and gentlemen, the moment I have that, I'll come and plug in these parameters here. So this will be 8 all over market value of a preference share is 80 minus 0. Remember what you are told in your normal classes. In your normal classes, you are told that in the event where the examiner does not give you the trading price of a share, where your examiner doesn't give you the market price of a share, always assume that that share is trading at par. That share is trading at par. The share is trading at par. So 0.1 times 80 is 8. So we have here 8 divided by 80 at the end of the day. You see, F is flotation cost. They haven't given us anything to do with the flotation cost for preference shares. They haven't given us anything to do with the flotation cost for preference what here? Preference shares. For preference shares. Now, ladies and gentlemen, let's straight away get this particular figure. This automatically will end up being what here? 10%. This automatically will end up being 10%. Will end up being 10%. The same. And if you allow me, of course, I'll take you to the last one, which is cost of what here? Cost of debt. So mention there, cost of debt. So we have here cost of debt. So for cost of debt, we normally take this as KD. Cost of debt is KD. Thank you very much, Eunice. Thank you very much, Catherine. And Phoebe, they were able to give me those answers. Yes, thank you very much. So cost of debt, how do I get cost of debt? I have to ask myself, these debt holders normally receive what? The debt holders, once in this case, somebody buys our bond, meaning that he has given us our money. In return over his money, we must be giving them interest. So the debt holders normally receive interest. And unlike all the other, ladies and gentlemen, instruments, interest is normally tax allowable. So remember, dividends are never allowed for taxation, but interest is normally allowed for taxation. So KD will be equal to interest into 1 minus tax all over market value of debt, all over market value of debt, market value of debt, of course, minus any flotation costs or discounts. You subtract them. You subtract them. So please write this in full. This is market value of debt. MVD is market value of debt. MVD is market value of debt. Market value of debt. Now, ladies and gentlemen, I would want us to go slowly. We have got two values of debts, two debt instruments. So we have the 9% debt instrument. 9% debt instrument. I would wish you guys to give me the interest here. The interest. Interest, how do I get the interest? I'll take the coupon rate. Coupon percentage rate is the 9%. So I will take 9% of the par value. 9% of the par value. 9% of the par value. So have they given me the par value really here? It'll be 9% of the par value. We are told in note 4. Please go to note number 4. Note number 4. Go to note number 4. Go to note number 4. Note number 4. 9% irredeemable debentures whose par value is 1,000. 1,000. So the par value here is 1,000. So the 9 over 1,000, that will give me 90 bob. 9 over 1,000 will give me 90 bob. So I would want you to come and take care of the denominator. The market value of debt minus any flotation cost will be equal to what? Please continue reading. Note number 4 tells us 9% irredeemable debentures whose par value is 1,000 could be sold with net proceeds of 95%. So basically, you know, this MVD minus F or minus any discount will be giving us the net proceeds. What are we going to get? So the net proceeds here will be 95% of 1,000, which will give us 900 what here? 950. Now listen and listen to me very well. Of course, we are still reading there. Please pin the question there for us. We are still reading there. Ladies and gentlemen, the next one, they're telling us, the next one, the next one, ladies and gentlemen, they're telling us there, 9% irredeemable debentures whose par value is 1,000 could be sold with net proceeds of 95% due to a discount on issue of 2%. So we have discount there. Discount, don't write this. Discount is 2%. So 2% of what here, somebody? 2% of 1,000, which will give us 20. What else is being deducted? The other thing that is being deducted here, they are telling us in that particular question, in this particular question, they are telling us that we also have shillings 30 flotation cost. So we have here 30 float. So in total, we'll be losing 50 bob. We'll be losing 50 bob. So to get market value of debt, of course, they haven't told us the market value. So we shall assume that this bond will be selling at 1,000. So then we have 1,000 minus 50, this expense here, 50, for us to get the net proceeds that our company will get, which is 950. So now, ladies and gentlemen, with this, really, I should be able to get KD without much hassles, without much hassling. We should be able to get KD. So KD, ladies and gentlemen, our KD will be equal to our interest, which is 90 multiplied by 0.7. Where have I gotten 0.7 from? Where have I gotten 0.7 from? It's because of note number 7. If my brother could pin the question there for us. Because of note number 7, where they're telling us that the corporate tax rate is 30%. And you see 1 minus 0.3. 1 minus 0.3 will give me 0. What here? 0.7. 0.7. 0.7. So we have here 90 times 1 minus tax all over the net proceeds. Net proceeds here are 950. Whatever I shall get there will be in form of decimal, so you need to come and multiply by 100, and then you give us an answer. You need to come and multiply this by 100, and then you give us an answer. Please help us there. Please help us there. Kindly help us here. Tell us this 9% debt instrument will be having what cost of debt? What cost of debt? I can see from Eunice, no, the 10% is an old figure. There is a student called Catherine who is giving me a figure of 6.63. Thank you very much, Catherine. 6.63%, 6.63%, 6.63%. So from there, ladies and gentlemen, go to the next one. The next thing is the 12%. So now we are through with the 9%. Let's pick up the 12%. So mention there 12% debt, 12% debt, 12% debt. So first of all, give us the interest. Interest will be 12% over 1,000 of par value. It is 12% of the par value. 12% of the par value is 120. Is 120. 1 minus tax, of course, I know is 0.7. My only concern is this MVD minus flotation cost. So the MVD minus flotation cost for the 12%, they have told us that the net proceeds are 90%. If you look at note number 4, the last sentence of note number 4, 12% interest with net proceeds of 90% of the par value. So 90% of the par value, which is 1,000, this will end up giving us 900. So now, having gotten that, indeed, what I need to come in and do here is to plug in. So we have interest in Ngapi, interest in 120 times 0.7 all over MVD minus flotation that we have as 900 times whatever we shall get there has to be multiplied with 100, has to be multiplied with 100. So could you kindly help us with that answer? And I would beg to stop there. So that when we come now in our next class, it will be easier now for us to pick up those things and do a graph. Which I'll be able to teach you. So I want to get the last answer. The last answer is 9.33. 9.33%. So kindly, I've given you my number. In the case of any questions, I will be able to answer them directly, even on WhatsApp, or even you can also give me a call, right? Otherwise, I would want to take this opportunity to thank you so much for having participated in this particular OTR, in this particular session. It has been a pleasure hosting you. God bless you. Good night.